My name is Oi. I'm the Chief Commercial Officer for iSTOX, and we have the obligatory disclaimer that I'm told I need to remind you when this is not an advertisement making an offer or calling attention to an offer. And we were just here for an informational session for this evening. Now, iSTOX is the first regulated capital markets platform. We are regulated by MAS in Singapore, and we use distributed ledger technology to bring about a platform for issuance, custody, and trading of digitized securities. So if you're curious to find out more before we, at the end of this session, please go to www.istox.com to find out more. Now, I will now hand over the screen to Manish.
Okay.
Thank you. And while Manish flips to the first slide, I want to remind everyone that we do have Q&A capability on the Zoom panel. If you just click below, you will see the two little speech buttons called Q&A. And please feel free to ask questions along the way. I will be asking Manish questions along the way, and we will actually have some time at the end of the presentation for all our participants to ask as well. It will be a wide-ranging and a very fascinating topic, so please feel free to type away, and we will, pick as many questions as we can to address all of them. So let's get going. I'm very, very happy tonight to have with me Manish from Straits Trading or Straits Investment Management. Straits Investment Management is an investment management firm. It's regulated by MAS. It's a registered fund management company. And very interestingly, it is a wholly owned subsidiary of the Straits Trading Company Limited. As some of you might be following the listed real estate space, STC, the Straits Trading Company, is actually listed on SGX and has diversified interests in real estate, hospitality, and resources across Asia Pacific. STC is the sponsor and anchor investor of SIM. It's obviously Manish manages that capital from STC. Next page, Manish. For SIM. It is a strong network. STC is a very, very old company. It's been listed for a long, long time. And it's been in real estate for a very, very long time. So it leveraging its strong relationships, offers valuable insights to market research and idea generation, and gives SIM team a very, very complete picture of what's happening in the global real estate world. STC sponsors are Straits Real Estate, AUM of 1.7 billion, and has crossed that 7 investment professionals, and Tessity Group, which is a large family office in Singapore with altogether 12 investment professionals. We're so happy to have here with us Manish Bhargava, who is the CEO and Director of Straits Investment Management. Prior to joining Straits Trading Company, Mr. Bhargava was the head of Asia, APN's Asian Real Estate Securities business, and the dedicated fund manager for APN's Asian REIT strategies. With more than 17 years in real estate investment experience, Manish is an experienced fund manager who's been responsible for investing in global real estate securities. Prior to APN Funds Management, he worked at Tiedemann Investment Group, a $1 billion global hedge fund headquartered in New York. He also worked at Starwood Real Estate, a property-dedicated global long-short fund based in the US, and European Investors, Inc., a property-dedicated long-only fund headquartered in New York. So Manish has had decades of experience in global real estate and certainly take a lot of that thought process and knowledge here to SIM, and share with us about his views and his strategies around that. And you can see he was covered recently by Business Times because SIM has actually done very well in a very volatile market, and that is also going to be a big point of discussion here. How is he thinking about managing through all this dislocation? Manish, I hand it over to you. Thank you for joining us again.
Great. Thank you, Oi. Happy to be here, and good evening, everyone. Like OE said, we are fund managers. We are a fund management company. SIM is based here in Singapore, and we have been managing money for ourselves, for high net worth individuals, family offices, and institutions. And we've been doing this for a while. So we've seen many cycles, and primarily we are real estate investors. And our thinking is that you can own real estate in two forms. One, you can go and buy a building, so that's direct investing, or you can buy a REIT or a developer that owns or develops these assets. Now, you may wonder, Singapore has many REITs, 40, 45 REITs here listed in Singapore, and some of them are great. They have done very well. They pay a nice dividend. So why should we go global? And the answer to that question in a nutshell is diversification. We have done a lot of research, we have back tested, we have run several different strategies. And what we have found is that Singapore REITs have a very low correlation to global REITs. And to give you some sense of it, it is roughly around 0.5, 0.6. It ranges, but I think it can give you an idea that the correlation is so low that by having an allocation to global can enhance returns, can dampen volatility. And let me flip to the next slide here to give you a more complete picture. This is a snapshot of global REITs, the global REIT universe. And you can see here that Singapore forms a very small piece of the pie. Let me share some numbers with you here. So in Singapore, there are roughly about 45 REITs. This is excluding, just for examples, for the sake of example, I'm excluding real estate developers from this. Let's just look at REITs for a second. So Singapore has roughly about 45 REITs, new IPOs, etc., keep happening. So roughly in that range, 45. Globally, there are almost 500 REITs. So you can see in terms of number count, it's less than 10%. When we look at the investable market cap, the market cap, investable market cap in Singapore is just about 5%. So there is a whole new world out there where many of you may not have exposure to. At the beginning of the presentation, we did the poll, and the answer to that question, the question was, how much do you have allocated to real estate outside of Singapore? And 50% of the audience said it's less than 10%. I wish there was a way for me to ask you why that was the case. Because what we have found is that just like in Singapore, there are some great REITs and great businesses, and there are great businesses, great REITs, real estate developers outside of Singapore. So my question to the audience would be, why not allocate a small portion of your capital to real estate outside of Singapore? Now, let's take another poll here. I'll hand it to Alex, and then I'll share some slides with you, which will hopefully prove the point. Wow.
Wow.
64% say data centers. Is that right?
Yes.
And also, so the clear winners are data centers and industrial REITs. Very nice. I think we have a very sophisticated audience here, OE.
Yes, I
And
agree.
rightly so, because just, a one-line thesis on that is industrial warehouses, logistics space has done very well this year because of COVID. Industrial has been a big beneficiary of COVID because all of us are sitting at home and doing some form of online shopping. And because of that, e-commerce sales have gone through the roof. Demand for industrials and warehouses has been very, very strong, not just in Singapore, but globally. The second was data centers, and rightly so, because all of us in some form or other are using cloud. When we are watching Netflix, it's being streamed from the cloud. When we are working on Microsoft Teams and Microsoft Office, it is now all on the cloud. Amazon is on the cloud. So demand for data centers is very, very strong. And we'll touch upon that in a couple of minutes. So this I thought was a very interesting slide, and I wanted to share it with you. So this is home builders or residential developers. In the white line on top is the U.S. home builders in the U.S. And the orange and the yellow line is Capital Land and City Dev, two real estate developers listed here in Singapore. And you can see how stark the performance has been. This is the share price performance, total return, that is dividend plus capital gain. And so let's throw in some numbers. Let's say in September 2016, that is about 4 years ago, if we had invested about $1 million in US home builders, today the value of that $1 million would be 1.6 million roughly. And the same $1 million parked in Capital Land or City Dev would be roughly about 950,000. So you can see the difference. It's not that we are taking additional risk. The same dollar allocated in A versus B would result in completely different outcome. And just a couple of data points on home builders. Because of COVID, the work from home trend has been so strong. In the US, we are seeing a trend of people moving from cities, city centers, major metros like New York, San Francisco, to the suburbs, to the exteriors. And everyone is working from home, either part-time or full-time. So they want to have a home office. As a result of that, demand for new homes, demand for residential dwellings has been very strong. And the second point on that is mortgage rates in the US have hit an all-time low. You can get a 30-year mortgage in the US for less than 3%, 2.9%, which is unheard of. So because of all this, it has fueled demand and a huge rally in home builders.
But Manish, if I may just sort of interject here,
Yes.
in Singapore, it feels like the residential prices seem to be still holding up. But I guess here the trend in the US, and because it's a bigger market and there's been so much pent up demand, I suppose that's why the home builders are, outperforming by a large margin.
Yeah, US also tends to draw a lot of global capital. So pension funds, institutions, high net worths, they all tend to gravitate towards the US because it's a beast when it comes to equity markets. In Singapore, if you are a very big pension fund, if you're a very big player, you may have some exposure to Singapore, but just because of size, you may not be able to allocate a big chunk to Singapore. So that is one. And second, also, I think in Singapore, there have been some policy restrictions, which is probably limiting investors, foreign investors to come in. And that's what is, and it's reflecting in the price. So So here's the ultimate picture. Price action is above everything, and this is the picture. It's quite a gap. I think the outperformance just since March is 60-70%, and so it's in the last 6 months that's been the divergence. So moving to the next slide here, which is on the industrial space. Industrial, we talked about it just earlier, that industrials, warehouses have done very well. And Ascendus, which is the white line, A-REIT, a household name here in Singapore, has done very well. Over the last 4 years, it's up about, call it 60-70%. Very nice. But if we look at Goodman Group, the orange line at the top, that's up about 170-80% over the same time period. Prologis, which is listed in the US, also an industrial player, is up about 100%. So again, if we try to quantify this, $1 million invested in Ascendus 4 years ago would be about 1.6 million. The same $1 million invested in Prologis in the US would be 2 million. And the same $1 million invested in Goodman would be 2.7 million. So again, the difference is quite stark. And the key point here is you're not taking leverage. You're not increasing the risk profile of your investment. Now, there is something called scarcity value. In Singapore, how many data center REITs are there? Just one. In the US, there are quite a few. If you look at it globally, there are even more. So when we are investing for our investors, we are first managing risk. We don't want to plonk everything into one name or one country. We like to diversify our bets, diversify our risk. And if we are bullish on data centers and we wanted to have a 20%, 20-25% allocation to data centers in the portfolio, would you be comfortable plonking 20-25% into one single name, no matter how good it is? I can tell you we would not be. We would love to have a 20-25% exposure to data centers in the portfolio, but spread across 4 or 5 names. So maybe have 4-5% kind of, have a 5% position spread across 4 names for a 20% allocation in the whole portfolio. That would give us a lot of comfort. We would be able to sleep better at night with that kind of allocation, as opposed to having 20% in one name. So, to all the Keppel DC REIT investors, they've done very well, and it's a great company. But there are also very good companies in the same space elsewhere.
But Manish, what was quite interesting about this observation is, in the year 2017, Keppel DC was underperforming Equinix and American Tower, right? So, right. It kind of is, if you put your investment dollar in 2016, it would be sort of the other way. So that diversification really works here, because in that year you had a different dynamic.
That's right. That's right. And I think from memories, Keppel DC is also a young REIT. It listed not too long ago. So it was a new kid on the block. It was trying to, find its footing. So there was a period of underperformance. Then it was, and ever since then, it has done well. Small fluctuations here and there are hard to justify, but it's a great business and with a very good management team, and has done phenomenally well. Alex, let me hand it over to you for the next poll. Okay, very
Oh,
interesting. USA is the clear winner there. 46% of the audience thinks are very optimistic on the US real estate. Great. And we would tend to agree with you on that, um, because very simplistically, the thesis there is US has come out and thrown the kitchen sink and everything out there. They have cut interest rates down to zero. They've committed to keeping them at those levels for the next 2, 3 years. The corporate governance in the US tends to be very, very good. It draws a lot of global capital. So the US real estate space could have a lot of tailwinds backing it for the next, you know, for in the medium term. So just like you, we are also bullish on the US when it comes to real estate. This is just a snapshot of of global office rents, and you can see that even though you're in the same sector, but real estate is such a local business that supply, demand, rentals, yield, vacancy can differ from city to city. You can be in Australia, but your numbers from Sydney and Melbourne could look completely different. So real estate is a very local game. And if you would like to build a real estate portfolio, a global real estate portfolio, I think it is important to have uh, to dig into the fundamentals, to do some research, to follow the property market fundamentals, to get a sense of how things are going, and then use that information to buy into companies and sectors that you're bullish on. And this is a um, similar chart just to show you how different uh, how differently rentals can trend. You can see here the blue line on top is Hong Kong, and recently it has pulled back. No surprise there because of COVID, because of the protests, whereas elsewhere they've held up relatively better. And and this is where diversification can come into play. If one was heavily concentrated in Hong Kong, the last couple of years could have been tough. But if the bets were nicely diversified, then there was a very nice buffer and cushion from the rest of your investments to to cushion out what has happened in Hong Kong.
I'd love to hear your views, Manish, before we start the next poll, as to how do you think COVID is going to impact, right? Because there's a lot of talk about co-working space, suburban office, distributing out or having less concentrated prime office space. Do you think that's going to play out, and will that impact this trend at a global level?
That's a great question. You're absolutely right. For offices, the future is a bit um, unclear. Because of work from home, we really don't know how it's going to pan out over the next 2, 3 years. Demand could be demand could be hit. Uh, because of that, rentals can come under severe pressure. I'll give you an example. In New York and London, two big office hubs, just about 10-15% of the population, of the working population, has gone back to work. So 80-90% of the office space is sitting empty. But because tenants have signed leases, they still have to oblige and they still have to continue to pay rents. But as soon as this rental cycle ends and the next one begins, um, our view is that landlords are going to give back some office space. I think that's more or less a given. The only question is how much are they going to give back? How much are rents going to fall? How much are they going to correct? Citibank and a whole lot of other firms have come out and said that they're going to open satellite offices in suburbs so people don't have to commute into the city, because as it is, not everyone lives in New York City, because I used to live there. So I know that most of the audience commutes into the city. Most of the audience commutes into London from faraway suburbs. So their commute could be as long as 1-2 hours. That's a good, 2.5 hours in the whole day. And if they can bypass that, if they can skip that commute and work from a satellite office closer to home, thanks to Zoom and technology, and if productivity doesn't suffer, then I think the office space is in trouble, especially in the bigger cities, bigger metros. Did I answer your question?
Yes, thank you.
Great.
So it remains to be played out, right? I think we're going to watch the space.
It remains to be played out. I think the future of offices is a mystery because of work from home and COVID, but industrial and data centers, there are a lot of tailwinds. Retail and hotels are the worst hit. They're really in trouble. So just by avoiding retail, just by avoiding hotels, you could have outperformed the market tremendously. You could have generated like tremendous alpha by avoiding that space. So that's just our 2 cents. Okay, I guess it's time for our next poll. Okay, interesting. So a mix of both. They like both yield and capital appreciation. And the good news is that real estate is one of the few places where you can get some yield. So, we are, as everyone knows, we are living in this world of zero interest rates. If we look on the right, the table on the right, that's a 10-year bond yield for a bunch of countries out there. And you can see a whole bunch of them are in negative territory, and most of them are around zero. And actually, if you strip out inflation from these numbers, every single one of them is in negative territory. So the real interest rate net of inflation is negative. So what are the implications of this? Number one is it's going to be very painful to sit in cash, because your cash today, if inflation kicks in because of free money, stimulus, and the paycheck program in the US and whatnot, if inflation kicks in, a dollar of cash today is going to have less of a purchasing power tomorrow. So sitting in cash is going to be painful. That's our view. Second, corporates this time have been very smart. They have taken advantage of these low interest rates and gone out there and issued a lot of debt. They have raised a lot of capital. So their balance sheets are well capitalized. I was just on the phone with a REIT in Japan last week, and they were telling me that they until last year, they were able to borrow money at 0.6%. This time round, they refinance and they were able to borrow money for 0.25%. Now, that is just unreal. It's unbelievable. So it's basically as good as free money. You take that, you buy a real estate asset yielding you 3.5%, and you're home. It's the power of free money, right? So I think it's going to be important to change one's view, change one's way of managing money in a zero interest rate world. So cash is going to hurt. Being in bonds is not going to generate that yield. And so therefore, I think two things can happen. One, investors will almost be forced to take on more risk. They will be forced to increase their allocation to equities. And if you're hunting for yield, real estate is still one of the places where you can get some of it. A global real estate portfolio is still generating about 4.5% of dividend yield. How does that compare with general equities? General equities is about 2%. Bonds is less than 1, almost 0. And cash, as we know, yields nothing. So this is the world we are living in, surprisingly, strangely, whatever you call it. But this world is with us. This world was unimaginable a few years ago, but we are living in it right now. And it is here to stay for the next 2-3 years. The Fed has come out and said that they're going to keep rates near zero till 2023. That's 2-3 more years. And 3 years of free money can be the biggest blessing for asset prices. We saw that in 2008 during the financial crisis when the Fed and central banks came out and did QE and cut interest rates. Asset prices went through the roof. There was a 10-year bull market in real estate assets. And if that is the path we are on, we could see some parabolic moves in asset prices over the next 3, 4, 5 years. This is a chart from the FT that I thought was quite interesting. So the blue line on top is AAA paper, which is supposed to be the least risky. So, and the red line at the bottom is B graded paper, which is the most risky. So common sense is that if you take a lot of risk, there should be a lot of return, right? High risk, high return. But how strange is the world that we are living in? We are taking a lot of risk, investing in B grade paper, B grade companies, and it's done the poorest. AAA paper, least risky, has done the best, phenomenal. And why is that? And maybe I'll switch to the next slide, and the answer lies in scarcity value. There is not enough AAA paper out there left in the world. Over the last 20, 30 years, we can see AAA paper has almost just disappeared. So those kind of companies are in scarcity. Those kind of companies are very good companies, very well-managed companies, and you can find them in bulk outside of Singapore. In Singapore, it's very hard to find those kind of companies, AAA paper. It's very hard. There are a few handful of names here and there, Temasek, some of them you can't even invest in. So in Singapore, you can't get AAA. So if you're looking for AAA, if you're looking for AA, you are sort of forced to think global. You're forced to broaden your horizon. You're forced to look outside and see, what's out there. So, yeah.
The Singapore government is definitely trying to encourage companies. MAS is trying to encourage companies here to, rate the bonds or rate the companies.
Yes, that's right. Singapore and SGX, they have been trying. I think let's look at this slide here. This is a comparison of general equities, the broader markets, and a similar trend continues. The white line at the bottom is Singapore's STI index, and the red line the orange line on top is the US S&P 500. And it's a very wide jaw. It's a very wide gap. Now, Singapore, I don't know what is going on. A lot of companies have delisted in Singapore. Some have chosen Hong Kong for listing over Singapore. But one argument to make in favor of Singapore is that, okay, maybe Singapore is in deep value territory here. It has done nothing for the last 4 or 5 years. So possibly this is the bottom. Possibly the only way to go from here is up. And S&P and these companies have done well because of growth and tech. And there aren't too many tech listed names here in Singapore. There aren't too many high growth names. Singapore tends to have a lot of dividend payers, more stable, established businesses like REITs, and they're good, but they don't deliver the exponential returns like Tesla and Alibaba and Zoom and Apple, which are all in the US, which have taken S&P to new highs. So let me stop at that and just if I can do a quick recap or conclusion. In conclusion, we feel that I can share with you what has worked very well for us is having an allocation to global real estate has done wonders for our performance, has generated alpha for us, has dampened the volatility in our portfolio. And I think that is only going to continue because of the point I mentioned earlier, that the correlations continue to stay low at about 0.5, 0.6, which is very, very healthy. And if you want to be a little tactical and more actively trade your portfolio, there again, those dislocations, I think, can give you opportunities to trade in, trade out, if that's your style. And there remains opportunities to capture that arbitrage, capture that mispricing. So let me stop at that. And if there are any questions or comments, I'll be happy to take that.
Well, I for one have a few questions, but I think this is time for a poll, which I like to pull up. And if the participants here, please feel free again to use the Q&A button right below. It's the one with 2 speech bubbles. Quickly key in your questions and post the poll. We can start the Q&A.
Private equity. Wow. 58.
Well, real estate's got a good score. Great.
That's great. And I would tend to agree with the audience because this could be boom times for private equity, because their model simply works on low cost capital. It works best when the cost of capital is low. If a private equity firm can borrow capital at near zero and use that to leverage and do a leverage buyout, they can really enhance returns over, if an investment is going to yield 3-4%, but they lever it 4 times, you can easily get to 12-15% kind of returns, 12-15% kind of IRRs. And that can be really fantastic. So I agree. I think private equity could have a great run over the next 2-3 years.
Great. I see some questions coming in, but I'm gonna sort of be the first to ask Manish. I think what was really quite fascinating was the ability for you to sort of look across a global portfolio. And, I think for a lot of us, we don't do this full time. We're kind of sit in office, we're doing our thing. It really is, and I suspect a lot of the home buyers is just because, we don't have the resources nor the time to think or research or construct. I mean, how do you, as a professional, think about it? Presumably, you have a team that helps you research, etc. But when you look at it globally, where do you even start? You know, how do you sort of make these decisions on allocation from a country perspective or even a subsector perspective?
You're right. You know, a lot of research goes into it. It's not easy when you're looking across geographies. It is not easy. It comes with a lot of effort. I think you have to put in your time and effort and do a lot of number crunching, data analysis. Um, also, be ready to kick the tires. So we attend conferences, we meet with corporates regularly. We are on conference calls with managements, and we have thankfully we are part of a very big group, so we have a lot of infrastructure supporting and backing us. We have research from all the banks, so a lot goes into it. But if for say the audience said that they had a view on data centers, and that theme is very strong, it has tailwinds backing it, and if that is your view, you can express it just by buying capital DC REIT and some other uh, data center REITs that are listed elsewhere, that may be, that are exactly in the same space. You understand that space, you have a view, you can express it nicely by taking a position in one or two similar names which are just as good but listed overseas.
Thank you for that. There's sort of fairly similar questions coming out of the participants' Q&A. So let's sort of jump right in. We have a question for Sophia, which would have been my next question. And again, this is Straits Trading to some extent has direct and as well as through yourself, professionally managing a portfolio. The question is, should we be buying properties directly or should we invest in professionally managed funds?
That's a great question. So, if you are looking to buy a property directly, is that the name Sophia? Is
Yes.
it Sophia? Okay, Sophia, that's a great question. If you're looking to buy a property directly, um, it was a different ball game. Number one is, of course, you need a lot of capital. Um, Not everyone has that. Point two is it's operationally very heavy. Owning an asset, owning a 50-story office building comes with a lot of operational hurdles, operational baggage. You have to manage that. You have to manage the tenants. You have to manage the leases. You have to manage the vacancy, etc. So it's not very light. And if that's your game, absolutely, you know, go for it. But if you are in a camp like us, where we think that that is way too heavy for us, we rather own a REIT which owns that asset. And if liquidity is something that you need, then owning a beautiful piece of building may not help as much. Of course, it can generate uh, uh, rental income, etc. But it may not. It may be a lot easier to own a REIT which pays a nice dividend. Most of them pay a quarterly dividend here in Singapore, and that can serve your purpose just as well. So I can share with you, for us, that model works beautifully. For us, we've also back tested numbers. What we have found, and it might be an eye opener for a lot of us, that in the long run, the returns from direct property investing versus investing in the publicly listed companies, in the long run, it's roughly the same. It's roughly the same in the long run. In the short run, it may not be an exact overlap because of the nature of the two investments. One is liquid, other is illiquid. So it may not be similar, it may not be same in the short run, but in the long run, they tend to deliver just very similar numbers. So So we have taken the form of the latter route of investing in the public markets, and that has done very well for us.
Well, I have to say, Manish, just thinking about property taxes alone and how to deal with that in a foreign country is enough to give me a headache. So I
Yes,
think
yes.
going
And
to a
yes,
fund is a
absolutely.
far better.
If you are looking to go outside of Singapore, go global, then there are taxations, lawyers involved, and all of that. You can easily buy a beautiful building in London, which sits in a REIT, and almost forget about it.
What are some of the examples of the research you do? Beside, you mentioned meeting management and all that, and some of the metrics you think about.
I think when you're looking at REITs in particular, uh, it, the standard industry methodology of valuing a REIT is an NAV model, which is a net asset value. You could also look at a DCF model, discounted cash flow, or you could look at a dividend discount model, DDM. And any of these three can work just fine. NAV and DCF tend to be more widely used and followed. So that is something you could build um, you could build on your own. It is time consuming. It takes a lot of work, and building a model is the easy part, but maintaining and updating it quarterly with numbers and updates, that is the more difficult part. So yeah, I think you can get all the numbers in from the public domain, from websites and financials, but using those numbers to come up with a meaningful valuation is the challenging part.
Well, and also, it's also the local knowledge, understanding, not just the supply and demand, but also capital flows, right? For
Right.
that
Right.
might be
Yes.
attracted in
Yes.
that country in one point in time.
And very regularly, we talk to banks and investment and property analysts at banks and other firms like, Cushman Wakefield, CBRE, and these real estate brokerage firms, because they have a lot of data. They see how the leasing trends are developing. They see how rental trends are developing even before it hits the market. So we try to stay on top of all of that. We try to talk to um, management and analysts and traders. I think if you talk to traders, they can tell you exactly, they have a very good feel for how money is flowing. If big institutions are buying, that is a lot of color that only traders can share with you. So we try to talk to a whole bunch of people.
Where it comes to deep discounts, how do you are you feeling like they're at the bottom of the barrel at the moment, especially in retail? Is it time to look at it, or you think there'll be more pain to come?
I think there could be more pain to come because again, the retail model could have been disrupted, and this disruption could be massive. In some pockets of the world, there was already too much of real estate, too many square feet of real estate per mile, etc. And so that model could have been disrupted. All of us, if I just look at and look at my colleagues and myself, and I talk to them about our consumption patterns, if previously we were spending 20-30% uh, online, now that number has jumped to 40-50%, maybe even more, because of what's going on. And the biggest risk to the market right now is a second wave. Another big risk is a hung election outcome in the US, which is coming up next month. So volatility is something we are watching very carefully. A data point I can share with you is that we've done a lot of research. We've gone back and back tested a whole bunch of US presidential cycles, and we have found that volatility tends to be about 4 points higher 3-4 weeks ahead of a US elections. And rightly so, right? There is unpredictability. We don't know who's going to win. And this time round, I think Trump is saying that he's not going to, he's not going to leave the White House. He's going to contest the outcome if he doesn't win. So that's what the market is most scared about. I don't think they care if Trump wins. If Trump wins, great. If Biden wins, okay. But if there is no decision, that is going to be scary for the markets. I think the markets will throw up.
Yeah, Daisy had a very interesting question around, the similar sort of as a follow-on to that. And I know you talked about election risk, but also that there's a confluence right now that the stock markets are ending at quite strong. And yet, at the ground level, the government's still talking about new pandemic relief package, et cetera, et cetera. So there's a bit of a disconnect between what Wall Street is doing and what the governments are doing. How are you feeling sort of outside of election risk? Are you still think that you should position for a bullish real estate stock market post that? And what is your strategy? Because you mentioned you could short as well. So how are you feeling about it?
I think that's a very good observation, that it has been a K-shaped recovery. Tech has done very well, and tech and growth have done very well, and value has not. In the value basket, we have oil, we have real estate, and a whole lot of other things. So it's very hard to tell where is the bottom. But one thing I can tell you with a lot of conviction is that the real estate space is in deep value territory, especially when you look at it against a backdrop of zero interest rates. And in the past, most recently during the GFC crisis, we have seen what zero interest rates, what free money has done to asset values. And if this commitment holds through from the Fed that they're going to keep rates low for a long period of time, then we could have another huge rally. So it's very hard to tell where is the bottom. I think calling the bottom has hurt people more than letting the bottom establish firmly and then you go in. So that's what we like to do. In certain pockets, we have seen bottoms being established. Price action has come back to test those levels, and they've held up very well. And that's where we like to allocate capital. That's when we like to go in. So I think they are in deep value territory, but not sure if this is the bottom.
So, well, basically the message is, folks, don't try this at home. Leave it with the professionals, because, Manish is up every night watching the US markets, right? We have time for one last question. And this is sort of another educational one. What are some of the traits to look at when you're evaluating REITs overseas? I mean, you mentioned management team and probably a little bit of sector, but what else might there be that you would look at?
I think if you're doing this individually, it's hard. But what the way to get started would be, maybe you look at it top down. If you have a view on a country or a sector, a subsector like industrial or data centers, then you can start top down. You can start looking, narrow it down and look at just the data center REITs, possibly in the US or elsewhere, or industrial. And again, I think we are big believers in big caps and liquidity because of two reasons. Because when a company gets big and it trades like a beast, it draws the attention of sophisticated investors, institutional investors. It becomes very difficult for any one player to come and move the price. In Singapore, we have seen some REITs are so small that if you are a big fund, one or two players can come and move the price. They can move it up or down 5, 10, 15% in one day. They can just dump the stock and the price will crash. And we never want to be in those kind of names. So we tend to avoid micro caps. We tend to avoid names which are very thinly traded for these reasons. So we draw a lot of comfort. Therein lies our point of capital preservation, because that's our mindset. That's what we aim to deliver. We are very comfortable investing in blue chips. We are very comfortable investing in large caps. We are happy to invest in names that have a lot of liquidity. So for any reason we need to exit our investment, we should be able to fairly quickly without moving the price.
Great. Thank you for that, Manish. I think we had this is a fascinating discussion. I love real estate, so this was fantastic. For everyone of our audience, thank you very much for joining us. I think Straits Investment Management has a newsletter that's on their website. You can, read Manish's thoughts on that website. And if you'd like to read a little bit more about data centers and logistics, iSTOX actually has a blog piece on our blog site. And again, go to www.iSTOX.com to find out more. And we again want to thank you for joining us tonight. And we hope you have a good evening and see you soon at our next webinar. Thank you very much, Manish. It was great speaking with you.
Thank you, Oyi. Thank you very much. It was a pleasure to be here.
Thank you, everyone. Good night.
Thank you. Good night.